You are always told to invest your money, even when the stock market is volatile. Some even say that now is the best time to invest because of the low prices. But exactly what you should invest in while you are young? You certainly don't have to invest in everything at once, but by choosing just 2 or 3 areas and constantly funding each, your wealth will begin to grow rapidly. Important considerations for young investors. Before we dive into some of the best assets to buy in your 20s, there are a few considerations young investors should keep in mind before putting their money to work. Important considerations for young investors. Before we dive into some of the best assets to buy in your 20s, there are a few considerations young investors should keep in mind before putting their money to work. Time frame. Are you investing for the long term, or do you need your cash within the next few months or years? For long-term investing, young investors can typically take on a bit more risk and trust that time and compound interest will work in their favor. In contrast, short-term investing generally means picking safer investments. Investing goals. Are you investing for income, growth, or some combination? Again, young investors can generally aim for higher growth opportunities since time is on their side, whereas older investors tend to favor fixed income, active versus passive investing. How much time are you willing to spend on your investing portfolio? Some investors prefer to stay hands-off and simply dollar-cost average into various index funds and ETFs, but for others, researching individual stocks and sectors might be more enjoyable. There's no cookie-cutter solution for the perfect investing style or philosophy, but the more you read and think about your goals, the more confident you'll become as an investor. The best investments for young adults in their 20s. With those considerations out of the way, it's time to explore some of the best investments to make in your 20s to set you up for success at a young age. Improve your skills. Learn investments. Most people don't think of improving their skills as an investment, but as a young investor, that can actually be one of the very best investments you can make. After all, the income you earn over your lifetime will be your single greatest asset. The more you can increase it, the more valuable it will be. Plan to invest at least a small amount of money and time in acquiring any skills you need in your career. You may also think about skills you want to add to prepare you for either a higher paying job or even for changing careers later on. You can take additional college courses, order online courses, or enroll in various programs that will add to your skill set. Sure, it will cost you money in the short run, but if it will increase your income substantially in the future, it'll be some of the best money you ever spent, and that's an investment in the truest sense. Invest in real estate investment trusts. Real estate is another growth-type investment strategy, and you absolutely can't get enough of those when you're young. Investing in a real estate investment trust is an opportunity to hold a portfolio of commercial real estate. This can be more valuable than owning a single investment property because the portfolio is invested in different types of property in various geographic locations. That gives you greater diversification than you can get with a single property. Another significant advantage is that you can invest in a real estate investment trust with just a couple of $1,000s. Buying an investment property outright would require a much larger amount of capital just for the down payment. Can also add that you don't need to actively manage a real estate investment trust the way you would with an investment property. A real estate investment have the advantage of investing in commercial real estate, which often outperforms residential properties. There's even an argument that a real estate investment trust have outperformed stocks in the past few decades, but even if the returns are no better than equal to those of the S&P 500 index, a real estate investment trust is still a valuable hold for young investors. First, real estate has been a strong performer over at least the past half-century. Second, and perhaps more important, real estate and commercial real estate in particular often moves independently of the stock market. Perhaps more than anything, a real estate investment trust are a way of diversifying your growth assets beyond stocks. You can also using crowdfunding sites like Fundrise and Streetwise, as it allows almost anyone to invest in private real estate deals for just $5,000. Invest using robo-advisors. If you're not comfortable with investing on your own, you can always do so through a robo-advisor. That's an online, automated investment platform that does all the investing for you. It includes creating your portfolio, then managing it from now on. They even reinvest dividends, periodically rebalance your portfolio, and offer various tax strategies to minimize your taxable investment gains. What's more, you can use a robo-advisor for either a taxable investment account or a retirement account, particularly IRAs. It's hands-off investing at its best. All you need to do is fund your account and the robo-advisor handles all the details for you, and they typically invest in a mix of stocks and bonds. Many also offer funds that focus on ESG stocks. Buy a home. This one's kind of a mixed bag. On the positive side, owning a home lets you build substantial equity over many years. This is done by a combination of gradually paying down your mortgage and the value of the property increasing. Owning a home also has the advantage of leverage, since you can buy a home with as little as 3% down, or no down payment at all with a VA loan. You can get the benefit of appreciation on a $300,000 property with an out-of-pocket investment of just $9,000. Even if you do nothing more than simply pay off the mortgage in 30 years, your $9,000 investment will grow to $300,000. That will increase your initial investment by a factor of 33. But price appreciation of the property can make that number a lot higher. The downside to buying a home when you're young is that you may not be at a point in your life when the relative permanence of homeownership will work to your advantage. For example, being early in your career, you may need to make a geographic move in the near future. If you do, owning your own home could make that move more challenging. If you're single, owning a home forces you to pay for more housing than you actually need, and of course, a future marriage could also hold the possibility of making a geographic move or needing to purchase a different home. Owning your own home is definitely an excellent investment when you're young, but you'll have to do some serious analysis to determine if it's the right choice at this point in your life. Pay off your debt. One of the major investment complications for young people is debt. Student loan debt alone is a major issue, with the average loan amount at nearly $38,000 for 2022. But many young people also have car loans and more than a little bit of credit card debt. The problem with debt is that it reduces your cash flow. If you earn $5,000 per month and $800 is going out for debt payments, you really have only $4,200 per month. In a perfect world, you would have no debt at all. But this isn't an ideal world, and you probably do. If you do have debt and you also want to invest, you're going to have to find a way to create a workable balance. It would be great to say that you'll just make your minimum debt payments and throw everything else into investments. That will certainly allow you to take advantage of the compounding of income that investments provide. But at the same time, there's an imbalance. Investment returns are not guaranteed, but the interest you pay on loans is fixed. Put another way, even if you lose 10% on your investments, you'll still be required to pay 4% on your car loan, 6% on your student loan debt, and 20% or more on your credit cards. One of the best investments you can make early in life then is to begin paying down your debts. Credit card debt is a good first target. They're usually the smallest debts you have but carry the highest interest rates. If you're paying 20% on a credit card, you won't be able to get that kind of return consistently with your investments. Paying off those credit cards is the best debt reduction strategy you can make. Investing isn't gambling. In general, you should never look at investing as a get-rich-quick option. Your chances of getting lucky buying the next big crypto or picking the next best stock are extremely slim. That's why it's important to mention the one investment that often touts maximum short-term gains, cryptocurrency. It's easy to fall for this myth with Bitcoin billionaires happening seemingly overnight a few years ago. But be warned that this is not a safe investment choice in most cases. The price of crypto is extremely volatile, and you can't be sure that you'll have any money left when you need it. Final thoughts. Because of income limits, it's not likely you'll be able to spread your money into all of these investments, but you should pick at least 2 or 3 and charge forward. Investing works best when it's done early in life. That will let your money grow, giving you more options in the future.